Good afternoon, class. Welcome to PLBC Virtual Classroom Simulation. I am Mubarak Sheikh Musawa from Hassan Osman Tasana Polytechnic. God's willing, today we will learn financial accounting for SS3. And the first topic for this subject is formation of a company. Now, why are we discussing formation of a company? The reason being that in our subsequent classes, we are going to learn how to prepare the final account of a company. In our previous level in SS1 and SS2, we've learned how to prepare the final account of a sole trader. We've learned how to prepare the final account of a partnership business. We've learned how to prepare the final account of a non-profit making organization. In our SS3, we are required to learn how to prepare the final account of a company. However, before we go into the details of which account to open, which account to debit, and which account to credit, we are required to revisit what we understand by the word a company, how a company is being established, what are the procedures in establishing a company, what are the documents required, what is the meaning of a share capital, and what are the types of company we have in Nigeria. Now, when we say a company simply means a business organization, just like a sole trader business or a partnership. Where two or more people in a sole proprietorship, we said it's a one-man business. In the partnership business, we said it's a 2 to 20. Now, for a company, we said it is an association of two or more individuals that have agreed to subscribe to the shares of a company. Or another definition of a company, what makes a company more distinct or more different from a sole proprietorship business or a partnership business is that a company is a legal personality. It has a distinct legal personality different from its owners. So a company is a type of a business organization which has a legal distinct personality different from its owners. So it means you have the owner on one side, the owners of the business on one side, and likewise you have the company on another side. It means they are two different individuals. So by this, it means you can sue a company and the company can also sue you. So a very good simple example is, for example, we have Dangote Cement PLC, which is a company. Now, by the time you sue Dangote Cement PLC, you are not suing the owners. You are not suing Aliko Dangote. No, you are only suing Dangote Cement PLC. Why? Because the company is different from the owners of that company. We have two different legal personalities. A company can sue, or it can sue. Likewise, we have a different owner. So by the time you sue a company, you're not suing the owner of a business. That is one. Two, another features of a company is that the death of one of the owners of the company does not bring to an end the business. Unlike sole proprietorship business or a partnership business, when the owner dies, there's possibility the business will liquidate. However, in the case of a company, if the owner dies, the business will not liquidate. It will continue to exist. In Nigeria, where do we the body responsible in registering companies in Nigeria is referred to as the Corporate Affairs Commission. This is the body saddled with the responsibility in registering companies in Nigeria. We call it the Corporate Affairs Commission. When you want to register a company in Nigeria, you go to this body. They will establish a company for you. And what are the laws required, or what is the law regulating a company in Nigeria? We call it the Companies and Allied Matters Act. The Companies and Allied Matters Act of 2004. This is the most recent act. Companies and Allied Matters Act. This is the law that regulates a company in Nigeria. So again, if you want to establish a company in Nigeria, you go to the Corporate Affairs Commission. The law that regulates a company in Nigeria is referred to as CAMA, Companies and Allied Matters Act of 2004. We have previous acts, but this is the most recent one of 2004. Now, if you want to establish a company, what are those documents that are required for you to submit to the Corporate Affairs Commission? If I decide, or me and my friends decide we want to establish a company in Nigeria, what are those documents that are required for you to submit to the Corporate Affairs Commission? We have one, we call it Memorandum of Association. We have two, Article of Association. We have three, the particulars of the directors and secretary. We have four, statement of authorized capital. We have number 5, we have statutory declaration. From a lawyer. Now, these are some of the documents you are required to submit to the Corporate Affairs Commission if you want to establish a company in Nigeria. We have Memorandum of Association, we have Article of Association, we have the particulars of the directors of that company and secretary, we have a statement of authorized capital, and likewise we have a declaration from a solicitor or a lawyer. What do we mean by the word, or what is the difference between Memorandum of Association and Article of Association? Memorandum of Association is just a document which governs how the company will relate with the members of the public. So it's more like a constitution, how the company will have relationship with the members of the public. While the Article of Association is a document that governs the relationship, internal affairs of the company. Any document, the document that will govern how the company will operate internally will refer to as Article of Association. Again, Memorandum of Association shows us how the rules and regulation in our relationship with the members of the public, while the Article of Association, it only governs how we are going to operate internally. So if you need information regarding the name, as a member of the public, you need information regarding the name of the company, what is the objective of the company, what is the registered office of the company, what is the authorized capital of the company, you just go and look for the Memorandum of Association. If you are looking for the rules and regulation guiding the internal affairs of a company, you go to the Article of Association, and information that you can derive from such Article of Association will include what will be the dividend policy, what will be the appointment and remuneration of an auditor, what will be the remuneration of the directors, what will be the remuneration of the secretary. This is a very common, students usually misunderstand or misunderstood the difference between Memorandum of Association and Article of Association. So again, this governs the relationship between the company and the members of the public. Article of Association only governs the internal affairs of the company. This is a very common question in WAEC and NECO. Now, like I said earlier on, the laws that regulate companies in Nigeria is referred to as CAMA 2004. Now, based on CAMA 2004, we have two types. We have different types of company. We have companies limited by shares. We have two companies limited by guarantee. And we have unlimited companies. So based on the Companies and Allied Matters Act of 2004, we have three different categories of a company. We have companies limited by shares, we have companies limited by guarantee, and we have unlimited companies. What do we understand by the word companies limited by shares? It means any company that is limited by shares in the event of liquidation. In case the company will be liquidated, when we say the company will be liquidated, it will mean the company will be dissolved. It will not exist again. In that scenario, usually companies have liabilities. They have liabilities. So in that scenario, whenever a company is being liquidated, shareholders of this company, meaning the owners of this company, will only lose the amount they have contributed as capital. While companies limited by guarantee, this is usually applicable to non-profit organization. So in this case, just like companies limited by shares, in the case of liquidation, members of the owners of such company will only lose the amount they have guaranteed earlier on to settle the liabilities of such company. Then lastly, we have unlimited companies. In this case, in the event of liquidation, owners will not only lose the amount they have contributed as capital, but also they will lose their personal belongings. So when you have an unlimited company and such company is being liquidated, and the asset is not enough, the asset of such company is not enough to settle the liabilities. It means the owners will not only lose the amount they have contributed as capital, likewise they will lose their personal belongings, maybe their houses, their cars, anything personal to settle the liability of such company. So again, based on CAMA, we have three types of company. We have companies limited by shares, companies limited by guarantee, and unlimited companies. Now again, companies limited by shares is subdivided into two. We have private limited liability company and public limited liability company. We have private limited liability company and public limited liability company. Companies limited by shares, again, is subdivided into two. We have private limited liability company and public limited liability company. Most of us are a bit familiar, or we've seen it in many cases. We'll see a company that has this acronym LTD. Then we'll also see another company that has PLC. Now, all this has legal implication. When we see a company limited by shares is private, it means such company will only have a maximum of 50 members. A maximum of 50 members as owners. So if you register your company limited by shares as a private limited liability company, it means the owners of such business or such company will not exceed 50. The maximum is what? 50 members, 50 owners. You cannot go beyond 50. Again, you want to, by the time you register your company as a private, you have to add this acronym, limited, LTD. So the moment you see a company, maybe Nakowa Limited, Nigeria Limited, it means such company is a company limited by shares, but a private limited liability company. I hope you understand. The moment you see LTD, it means a private. And also another feature of a private limited liability company is that their shares is not traded on the floor of the stock exchange market. Their shares, meaning they cannot transfer their shares publicly to the members of the public. You cannot go to the Nigerian stock exchange market and say you want to sell your shares for a private limited liability company. So we have three features of a private limited liability company. First, the owner should not exceed 50. Second, if you register your company as a private limited liability company, you have to add this acronym, limited, LTD. Thirdly, your shares cannot be traded to the members of the public, meaning you cannot go to the stock exchange market and sell your shares. Now, what do we mean by company, a public limited liability company? A public limited liability company has this acronym in front of it, PLC. So the moment you see PLC, it means it's a public limited liability company. That is one. Two, it does not have a limit to the owners of the business. It means it's infinity. There's not a particular limit of owners of a business for a public limited liability company. You have as many shareholders as possible. If you want to have 1 million, it's okay. 2 million, it does not have any limit. Unlike a private, that it says the maximum owner should be 50. For a public, there is no limit. No limit in the owners of a business. And thirdly, their shares can be traded on the stock exchange market. So again, for a public limited liability company, you will see PLC in front of it. It means it's a public limited liability company. It means the owners, it does not have a limit to the owners of the business, and it means their shares, meaning you can gain an ownership. They can sell their shares on to the members of the public. You want to become a member, or you want to become an owner of such business, you just go to the stock exchange market and buy their shares. Then you become one of the owners of the public limited liability company. Now earlier on, we said one of the requirements for you to establish a company is you have to tell us what is your authorized capital. We all know the meaning of a capital, the initial amount you use to start a business. Now for a company, you have to disclose what is the amount of capital for such company. Now in accounting, we have different forms of share capital. We have what we call one, the authorized share capital. We have two, the issued share capital. We have three, we have call up share capital. And number four, we have the paid up. So like I said earlier on, you want to register a company, one of the requirements is for you to submit your authorized share capital. The authorized share capital is what we are required to submit to the Corporate Affairs Commission, and it is that capital that states the highest shares. This capital states the highest shares a company can sell to the public. Another name for authorized share capital is, we call it nominal capital or registered capital. We call it nominal capital or registered capital. So it is the highest share a company can sell to the public. Then we have issued share capital. Now, like I said, you have to, as a company, you can sell your shares to the members of the public. Now, part of this authorized capital is what you call the issued share capital. That part of the authorized capital that you sell to the public. Issued share, from the word issue, is the portion of this authorized capital issued to the public. Now, there is what we call a called-off share capital. The called-off share capital is that capital that the directors of the company have requested the public to pay. Part of this issued share capital, there is a part of the capital that the board of directors will say, please come and pay. That's what we call the called-off share capital. And lastly, we have the paid-off share capital. The paid-off share capital, from the word paid up, it means it is the amount received by directors So by the time the directors have requested for you to come and pay, the actual amount they have received is what we call the paid-up share capital. And lastly, for this topic today is what we call, we'll be discussing the word shares. What do we mean by the word shares? The word shares means the unit ownership of a business. Usually, or most cases, companies, the entire worth of that company is being divided into different categories so that the public can come and subscribe. So if a company has a capital or the entire worth is worth 1 million naira, they can divide it into different units. They can say this 1 million naira is subdivided into 1 million shares. Come and buy each share. And they'll tell you for each share, maybe the cost is 1 naira, 2 naira, or 3 naira, depending on the value of such company. That's what we mean by the word shares. We have two types. We have the ordinary shares, and we have the preference shares. We'll start explaining the preference shares from the word preference. It means if you buy preference share as a shareholder, it means you're going to have preferential treatment. And what do we mean by preferential treatment? It means dividend. You will be the first person to be paid a dividend. When we say dividend, it means the profit. You have established, you have contributed your money to start a business, you are expecting a profit. Now, after the end of the year, the company will declare profit or loss. If they have declared profit, you will be the first person as a preference shareholder to receive dividend. And usually, their dividend is fixed. Their dividend is what? Fixed. So again, you will be the first people to be paid dividend, and again, their dividend is fixed. Also, they don't have the right to attend annual general meeting. There's what we call AGM, annual general meeting. This is a case where companies will call all the shareholders to come and attend. Now, if you have a preference share, you do not have the right to come and attend such meeting. So we have three features for preference shares. One, they are the first people who have been paid dividend. Two, their dividend is fixed. Three, you don't have the right to attend the annual general meeting. Ordinary shareholder, or we call it equity shares, after the preference shareholder has been paid his dividend, the next person that will pay his dividend is what? The ordinary shareholder. So it means after they have settled the preference shareholder, the remaining profit will be divided or will be allocated to the ordinary shareholder. That is one. Two, he has a right to attend annual general meeting. So by the time they call for annual general meeting, the only person that will attend in the shareholder categories is the ordinary shareholder, where he can contribute on how to appoint the next auditor and what will be the remuneration of such auditor. So in a nutshell, today we have learned what is the meaning of a company, how a company differs from the other forms of business like sole proprietorship and a partnership business. What are the procedures in establishing a company? What are the types of company based on the Companies and Allied Matters Act of 2004? What is the meaning of share capital and what are the categories of share capital we have? And finally, we discuss the meaning of shares and what are the types of shares. Like we said, we have ordinary shares and we have preference shares. So this brings us to the end of today's session. So we'll meet in the next class.